Okay, so this is kind of a relevant topic right now because it's that time of year where people start getting their W-2 forms from their employers telling them how much, obviously how much money they made last year, how much tax was paid to the various governments. And it's time to then go to either an accountant or a service or a software and do your tax return, your income tax return for the year. And I always hear these horror stories from people who work W-2 wage jobs. Basically, they work for somebody, but yet somehow they owe all this money to the IRS in taxes. Like, wait a minute. Shouldn't your workplace be subtracting out what you owe in taxes and paying it to the government? You shouldn't have to worry about that. If you do your taxes via H&R Block or TurboTax or do it yourself or whatever, and you realize that you owe all this money in taxes, something is wrong. Your employer is messing up the math. So that's kind of why I want to do this, because I didn't really realize how this stuff worked until a few years ago. And tax brackets are a very contentious political issue, and I think that most of the reason why is because people don't quite understand the arithmetic associated with them. Even congressmen a lot of times don't get it, and that's sort of what I have this article here from the news magazine Vox. Okay, obviously they're here, and there was a big stink a few years ago about a proposal to have a higher marginal tax bracket. And a congressperson was accused of not understanding how tax brackets work, which I believe that there's probably a few of them that don't get it, which is quite sad. But for us everyday people, most people I run into where the topic comes up, they'll say, "Oh, I'm in the 22% tax bracket. Oh, I'm in the 12% tax bracket. I'm in the 24% tax bracket." And there's this assumption in our brains that that is our tax rate. That's what we pay in taxes. But the reality of it, it's not quite that. It's a little bit different. And it's really important to realize this, because when a proposal comes up to change these brackets, it really gets people worked up, because there's this idea that, if we had a very high bracket, like say 70% or 90% even, which was a real tax bracket in the 1950s, that anybody that falls into that has an income that falls into that category is going to have to hand over 90% of their money to the federal government. And even if you are, suck it to the rich, kind of attitude, it still seems pretty unfair. So, is that really how it works? And we're going to find out here that it's a little different. So, let's just take the example here of a person making an income of $84,000 per year. So, income is basically all the money you get from working for a job, for an employer, working, yourself as self-employed, or short-term capital gains, which is selling shares of stock within a year. Things like that are income. And they're taxed at these income tax brackets. So we have, I don't know how many brackets we have. I think the highest one is 37% or 36%. But you've got a 10%, 12%, 22, 24. 24% tax bracket stops at $160,000 and $160,725 in income, annual income. So a very large fraction of the people in the United States, what we probably hear as described as the middle class, falls into either the 22 or the 24% ranges. And you think, oh, that's what they pay in taxes. All right. Well, in reality, we actually have to fill up these lower brackets before we start getting into these brackets. So if you're making $84,000 a year, you're right at the edge of the 22% tax bracket. So the answer to how much tax you pay isn't 84,000 times 0.22. It's actually 9,700 times 0.1, that number, plus 39,475 minus 9,700 times 0.12, that number, plus 84,000 minus 39,475 times 0.22, plus this one. And then it comes out to a value of about $14,338, which, divide that by 84,000, comes out to 17%. So you're actually only being taxed at 17%, not 22%. That's a 5% difference there. Five percentage point difference. A much bigger absolute difference. More like almost a 20% absolute difference. So that's a big deal. It's a pretty big deal. So the other thing here is, okay, I always hear people say things like, oh, I got a raise this year, or I got a bonus this year, an extra $1,000. But guess what, everybody? It doesn't matter because the federal government's going to take it all in tax. Wait a minute. I hear these myths all the time, either that you're going to fall into a higher tax bracket and it's going to rip all your earnings that otherwise would come from that bonus. The other thing I hear people say is that bonuses are taxed at a higher rate. No, they're not. Your bonus is taxed at the same rate as your regular income. Okay, I hear people say things, oh, bonuses are taxed at like 40%. No. They're taxed at the same rates as your normal income. I'm not sure where that comes from. If you win the lottery, how is the lottery taxed? Okay, that may be considered a something other than income. But if it's considered income, it's taxed at the same rates as this. Generally, this is it when it comes to income. The only people who get to choose lower taxes, to my knowledge, lower tax rates than this, is if you have capital gains, which is like selling a share of a stock or a bond that's older than 1 year. You realize the capital gains. You make the basic. If you bought the stock at $100 and you sold it at $200, you realize a gain of $100, and you have to pay capital gains tax on that $100. And it is, depending upon your income level, either 15% or 20%. So $15 or $20. That's a lower rate than these are. But we're not worried about that right now. Let's just say that politicians in Washington want to add a tax bracket for, very, very high amounts of money. So we can see this one here, this 24% stops at $160,725. Let's say we want to put a tax bracket of like 70% for people making over $1 million a year. Okay, or $10 million a year, whatever it is. Do they pay 70% of the $1 million a year? Do they pay $700,000 a year in taxes and only get to keep $300,000? No. They have to fill up all of the brackets before the $1 million bracket. So if the tax bracket is 70% of is 70% above $1 million, and they're making $1,001, they're only paying 70% tax on $1. $1,001 minus $1 million. So whatever the previous brackets were, that all added up determines what they actually pay in taxes. And it's not going to be anywhere near 70% of $1 million. It just would not fly. And back in the 1950s, when we had the highest tax bracket of like 90%, the only people falling into that category were the top of the top. And they were only paying that 90% on the very last sliver of their income. Let's see if we can find out maybe what the top tax bracket was. You know, what that income level was in the 1950s. If I can type on this thing. Historical income tax brackets, 1862 to 2021. This will tell us. All right. As long as I don't have to download data. All right. Oh, wow. Okay, so here's 2021. They look very similar to current. Actually, they've increased. The 24,000 bracket now stops at 172,000 in income. The highest bracket is 37%. You have to be making over $628,000 a year income to be, you know, and of course, actually that's for married people. Single people, it's $523,000 a year. And so when we talk about this 37% tax rate, it only applies for whatever money above $523,000 a year that you're making. Okay, there's not a whole lot of people in the United States that fall into that category. It's not a very large segment of the population. So let's go all the way back to, it's going to take me a little bit here. Go back to like the 1960s or 50s or something like that. 70s, 75, 73, to 68. So in 1968, there was, holy cow, there's a lot of tax brackets back then. The highest one was 70%. And if you were a single person, you had to make over $100,000 in 1968, which is worth probably $800,000 today, or something like that. Let's go back to see if we can find anything higher. But like compared with today, people think that our tax laws are so complex. Oh, it's so complex. Look how many brackets they had in the 60s. There's like 20. I mean, holy cow. It's amazing. Here we go. There was a 91% tax rate in 1961. So in 1961, if you made over $200,000 as a single person or $400,000 as a married filing, you had to pay 91% of whatever was above $400,000. But if you were down here in the, let's say a normal income in those days probably would have been like $4,000 or $8,000, 22% was the tax bracket. And the lowest tax bracket in 1961 was 20%. Today, we have a 10% bracket. We have a 12% bracket. So anybody making between $4,000 and $0 and $4,000 pay 20%. Okay? So that's kind of the history of it. But today we have like 6 brackets. I think so. The highest is 37%. In 1961, they had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, like 24 tax brackets. So this was before most people had computers to do their taxes on. So if you're sitting and you're doing this yourself, or your accountant's doing it on paper, they have to do all these bins out by hand, and then add up the dollar value for each one up to whatever you whatever your rate or your income was. Now, I can tell you that by looking at these numbers, most people only fell into like the first two or three at the most. 12,000, 16,000, this was in 1961, $16,000 was probably a pretty substantial income. Probably, almost like 100,000 today. But they were being taxed at 34% marginal rate, whereas a person making 100,000 today falls into the 24% category. So there you go. If you're doing your return and you owe a bunch of money, go to your employer and say, hey, why is this happening? Why do I owe this money? Okay, you can obviously you could do the math yourself. That's beyond the scope of my discussion here. But if you go to your payroll person, whoever it is, they should be able to explain what's going on. And if there's a mistake, they'll either reduce how much they deduct or they'll increase how much they deduct in order to make it so you don't have these huge... Because what you're doing is if you get these great big returns every year in error, you're effectively loaning the federal government money that otherwise you could use yourself. Likewise, you don't want a surprise where you have to pay all this money. So that's kind of the story on taxes.